What's going on? Welcome to my channel. I am the covered call guy, and on this YouTube journey, my goal here is to create $120,000 in annual passive income using covered call ETFs, subject to change, of course. Once I reach my goal, I'm gonna use the extra monthly distributions or extra income to rotate into something else, possibly dividend growth income, dividend ETFs or single stocks. I don't know. I'm open to all options. Leave them in the comment section below. My projected annual dividend slash options income right now is about $82,000 a year, 6.8K a month, 1.5K a week, and about $226 a day, $9.42 per hour. Legal disclaimer before we start though, this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I'm just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, let's talk about today's video. It's going to be on the NEOS Grandmaster strategy. All right. I talked about an all NEOS portfolio, but this one is a little bit different. Why? Because I'm going to be talking about the perfect all NEOS portfolio breakdown with the new releases of their boosted ETFs, right? So that has been included. So the goal here is to beat the market with less risk, and the method is going to be the perfect portfolio mix of just NEOS. The end game is we want perfection, and how do we achieve it with just an all NEOS holdings? All right, so why your portfolio may be broken, right? I'm going to be talking about the holy grail of modern portfolio theory, right? It's a strategy that can outperform the S&P 500, right? The alpha here, right? While simultaneously exhibiting lower drawdowns than the index itself, right? This is protection here, right? So my NEOS Grandmaster strategy solves the upside cap dilemma of traditional income funds, right? So I'm not relying on hope or just conviction here, right? I'm relying on structural arbitrage of blending synthetic leverage, Section 1256 tax efficiency, and volatility risk premium. All right, so reality is the structural edge here. With NEOS, with the new release of the boosted, we can kind of build the structural edge to outpace or match the index. Okay, enter the matrix, the NEOS ecosystem, right? So I've analyzed the complete NEOS investment ecosystem to construct my quote unquote, of course, perfect NEOS only portfolio. We're going to be using the boosted, right? The new release of the 1.5x leverage solves the upside capped dilemma. We're going to be using their hedged, right? Put spread collar protection without lagging, and their structural of blending synthetic leverage and Section 1256 tax efficiency. The goal, structural alpha. All right, the money printers, right? Core high income, right? So a little introduction for those who are new, right? These funds provide my portfolio's foundation, right? Offering index plus income with a beta of 0.7 to 0.8. That's where we want to be. We don't want to be one for one with the index, right? That can get dangerous. All right, so how does NEO achieve it? Well, they use a call spread strategy to capture some upside while generating tax efficient income, hence the Section 1256 contracts. How do they do this? Well, SPI, right, does the S&P 500 high income. This is the flagship. They target the yield of about 10 to 12%. QQI, NASDAQ 100 high income. This is the flagship of the tech focused core, right? They target the target yield is about 12 to 14%, so slightly higher, give or take about 2%, right? IWMI, this is the Russell 2000 high income, small cap exposure, high volatility harvesting with this one. And NIHI, this one does the MSCI EAFE high income. This is the international developed market exposure. This is your foundation. This is the cash flow. This is where you're going to be trying to build around these four. All right, what is the rocket fuel of their series? Well, it is the boosted series that they just recently released. The mechanics behind these series is that we need it to play a critical role for my ability to beat the market. It solves the upside cap by engineering a 150% notional exposure. How does it do it? Synthetic leverage. What it means is I replicate a stock exposure by buying a long call and selling a put short. The effect of this is that it creates torque, right? You think of it as a car. In a bull market, the extra 50% exposure powers through the drag of any sold calls, ensuring I captured the full rally. All right, so the arsenal that they have released is XSPI. This is the boosted S&P 500. The target yield is 15 to 18% with a 1.5x beta. XQQI. This is the boosted Nasdaq. Target yield of 18 to 24%. With a 1.5x beta. And of course, their boosted Bitcoin, right? XBCI. Target yield is high volatility of 1.5x beta. This is the alpha right here. This is where we get the 1.5x torque. We go in. Right. So this is the torque that's going to boost us when the bull market does come. All right, so what is the bulletproof vest that we do need in the portfolio of all NEOS? It is their hedge equity. So unlike the core funds, which only buffer downsides via premiums, right, we need funds that actively buy put protection. And hence, right, they utilize a zero cost collar or put spread strategy by selling calls to fund the purchase of protective puts. And some of these are SPY H, right? S&P 500 hedged, right? Designed to capture 80 to 90% of upside while strictly limiting drawdowns. QQH, this is the NASDAQ 100 hedge. This is essential for dampening tech crashes. And then they have NLSI, this is the long short equity. This is more of a specialized fund that can go long and short. So it can act as a non-correlated absolute return vehicle. Very important part of the piece when we want to build an all core NEOS portfolio. All right, so here is just the protection. You are buying a floor. That way you don't go beyond it. You don't crash down. This is where you stop. Okay, what is the safety net? Well, this is their enhanced fixed income. So these funds replace the bond portion of a 60-40 split, right? Pretty boomer-like. That's not what we're all about. We are going into the new millennia, the Gen Z type of investing, right? So this one uses short-term instruments plus put spread running on equities to generate 6% plus yields with minimal, okay, they aim for minimal duration risk. And some of these are SCHI. These are the 1 to 3 month T-bill plus put spread. The ultimate safety value valve here that they have. Near zero correlation to crashes. They have BNDI. This is the aggregated bond plus put spread. This is the broad bond exposure, and then they have HYBI. This is the high yield credit plus options. All right, these are the more junk bonds with an option kicker, and then they have the TOTI with the 20 plus year treasury plus options. These are the long duration play, right? Bet on falling rates. All right, so this is the ballast part, right? This is where you just sleep well at night. Again, you can choose any one of these. You don't have to have all of them. Right, if you want short term, go ahead and put it short term. If you want long term, go ahead and long term. Right, so these are just one of the 4 that you should have. Just pick one, whatever fits your needs. All right, let's look at the spice rack. This is the crypto and sectors. And this is the very high octane or sector specific tool for diversification. These are the digital assets, right? BTCI, Bitcoin high income, and NEHI. This is the ETH high income, right? So these are more commodities of kind of like the digital gold. They also have, well, gold high income, which is IAUI, right? Sectors of real estate is also IYRR. These are the real estate high income, and MLPI, which is the energy MLP high income. So I would use these sparingly to add on non-correlated returns to my core portfolio. If you're into gold, go ahead and get gold. If you just don't want crypto, you have gold. And if you don't want gold, you have real estate and or energy. So here I would say this is the flavor. Just pick one of the flavor here, right? This is not a core. This is not a hedge. This is not the boosted. This is where just pick one, whatever you want. You want a specific sector like real estate? You love real estate? Get the real estate. All right, designing the perfect Grandmaster portfolio here, right? This is the ultimate chess piece that we're trying to build, right? So you demanded a portfolio that can beat or match the underlying while providing downside protection. To achieve this, I cannot simply use core funds such as SPI or QQI alone. Of course not, as they will conceptually lag in a massive bull market due to the call cap. So this is my Grandmaster ratio of 25, 50, 25. So I calibrate the specific funds to balance leverage against hedging. My ratio, I think, is the best mix is 25, 50, 25. This is my NEOS Trinity allocation. So my accelerators, 25%. I'm just going to stick with 12.5 each into XSPI, XQQI. My role for these two, these are my alpha generators. Like I said, 1.5x leverage to ensure the portfolio keep up with the rallies. And then, of course, my core, 50%, 25 each into SPI and QQI. These are my income engines. All right, so I need the stabilizers. This bulk of cash flow comes from this portion, right? The 12 to 14% yield. And of course, we need the shield of my portfolio. 25%, 12%, 12.5% split into SPY H and QQH. This is where I said this is the downside floor, right? Long put spreads limit significant crash damage, while all three will still be providing me a significant income. This is my build. This is my index neutral. Like I said, of course, you can sprinkle that 0.5% into sector specific, or you want to if you want to take away 1% from the accelerators and put in something else, and then 1% from the shield and put it into another thing. Of course, that works too. But here's just my general 25, 50, 25% split. This is it. I think this is the NEOS Trinity right here. All right, rebalancing the no sell alpha. Of course, we don't want to ever sell. This is what this channel is all about. We don't want to sell. We want to live off our income forever for the next 30, 40, 50 years, right? So the income holds, right? So I need to generate massive monthly cash flow, hopefully 1.2% per month from the option premiums. Redirect, don't sell. I would never sell my winners. I simply direct that new monthly cash into the bucket that is lagging. And accumulation, if the market crashes, well, I use the income to buy cheap boosted shares. And if the market rips, I buy more shields, right? The method here is drip and rip. That's it. It rhymes, easy to remember. Keep dripping and let it rip. Don't sell, rotate. All right, so how do we win when the stocks rip, right? So, of course, the bull market math here, right? So, upside capture. This is the challenge, right? Standard cover call funds like SPY might only capture 70% of a rally. Well, I do have the solution here, right? Accelerator bucket, XSPI and XQQI operates at 150% exposure. The result here is the 1.5x leverage from the top 25% of the portfolio mathematically compensates for the capped upside of other segments. Okay, this is the weighted beta estimation. I think this is pretty good, up about 0.96. It is near index correlation, but not really, right? So my portfolio runs at a near market beta of 0.96, but with a massive yield advantage, right? If the market rips, the boosted segment ensures I don't get left behind. Simple math, the leverage wins with this portfolio. Okay, so but how do we survive a crash, right? This is the bear market map, downside protection. My challenge here is 100% long portfolios like SPY and QQI take the full hit in a crash. This is my solution. The shield bucket of SPY H and QQH has a put option floor. The result is in a severe correction, let's just say the market tanks 20%. Boom, you get smacked. Well, the accelerated bucket will hurt, right? It drops 30% because of the leverage, but the shield bucket might only drop maybe 10% due to the puts. The core bucket suffers as a buffer, but you're also getting paid. The insurance is that you have synthetic buffer. You're all limiting how much your portfolio can drop while also getting paid. That is the important part. Okay, so the income advantage here is 14 to 16%. Right, this is the crucial part. Right, crucially, the income generated acts as a synthetic buffer, offsetting price declines. Reinvesting this income creates a snowball effect that allows the total return to exceed the underlying index over time. This is the feel, right? Think of the snowball going down the hill. It gets only bigger, and it gets even bigger quicker when you add more to it. Okay, how do I build this beast? Zero selling. One, of course, if you're new, open up a brokerage account, right? I prioritize taxable accounts to utilize this section 1256 tax advantage, 60/40 tax split. And I personally, if I'm new, if I like this, I buy the 6 tickers. That's it. All you need is 6. Accumulate to rebalance. I never sell. I use the 50% annual cash flow to buy a specific bucket that is underweight, right? I turn time in the market into time in the market by constantly buying the cheapest asset with my dividend. The execution is just accumulate. That's all you have to do with this portfolio. Just keep accumulating. You don't have to buy anything else if you don't want to. Right. Of course, let's look at the hidden alpha of section 1256. We're going to be looking at the competitors of JEPQ and JEPB. Right, they use ordinary income. Right, the tax rate is 37% at the top bracket, so you lose $6.3 thousand. Right, pretty much, and you don't lose. You keep $6.3 thousand, and you have to pay 3.7. That's what you lose with the math here. With the NEOS advantage here, NEOS uses an index option tax that is 60% long term, 40% short term. Tax rate is about 26% blended. With an if you get $10,000 income, you keep 7.4. Right, so you're paying less, and this matters as you build up your income over the course of 10, 20, 30, 40 years, right? So the edge here is at least you're up with 1.1K of free alpha and just choosing NEOS. All right, we're going to be looking at the competitor kill list, right? Comparing it to the giants and the quality, right? So you can see here, NEO is great for conservative growth, but fails to match the income or structural protection of the NEOS Grandmaster plan. This is the NEOS trinity of my all NEOS all-weather portfolio, right? My verdict here is that NEOS absolutely wins against even the giants and even the quality of devil. All right, this is the very important part. I hope you made it to this video, to this section of the video. It's the Sharpe ratio. I have to mention this. Okay, this is a deep dive here. This is a sleep test. What is it? Well, what is the Sharpe ratio? Ideally, you want to make money without having a heart attack, right? I always talk about this in my video. You want to sleep well at night. The Sharpe ratio measures return per unit of stress. The formula here is return minus risk-free rate over volatility. We want to keep the top number high and the bottom number low. I'm trying to break it down as easy as possible, right? The NEOS cheat codes for this is that 1, the numerator, which is the return, right? My boosted funds like XQQI pump this number up by capturing 100% of the rally. And the denominator, which is the volatility, is my hedge funds, right? SPY H crush this number down by limited crashes. The result here is that it gives me a portfolio that drives faster than S&P 500, right? The return, but feels smoother, less risk. So, right, remember I said it's about a 0.96, right? That's where we want to keep. We don't want to constantly be one with market, right? That's not always the best case scenario, right? This is efficiency. Sleep better, sleep well at night. Hey, retirement cheat codes sequence of returns. Let's talk about the 4% root trap here. If the market crashes 20%, selling 4% of your shares depletes your principal permanently. You're essentially cannibalizing your future recovery. My Grandmaster chess fix here is that I don't ever sell shares. I live off the 50% cash flow, and in a crash, I keep all my shares. When the market recovers, if you bought the dip, if you rotate it, my principal is fully intact to ride the wave back up. This is the safety here, right? Never sell low. We don't ever want to sell. That's like the last resort. All right, so that's the end of it for my video today. I hope you guys enjoyed it. Hope you guys are staying tuned with the NEOS update as I am. I'm really looking into the new core right now. I'm not selling any of my amplified or Goldman, but I am starting to look into expanding my NEOS buys. So thanks for watching. For those who are new, well, What do you think of the perfect all-in for NEOS lovers video? If you liked it, please give me a subscribe, like, notification on, leave a comment. I appreciate everybody's comment. I do read them all. And if I don't reply to them, just know I do read them. I try to take some time out to reply. You guys are the best. Thanks for watching. Stay tuned. Love you all.